fiat money. So this is something that's out there. This is a token provided by the government, and it takes in revenue when it provides it, because people need this token. All right? And so this is not a debt of the government. So if you want to compute the debt consequences for the government, if this was also debt, then these two items would offset each other, and there would be no net benefit in terms of debt. But in fact, what we're doing here is a huge debt equity swap throughout the economy, where the government, at the end of the day, after it has done all the other parts of the Chicago plan, ends up with negative debt, slightly negative debt, in the particular implementation that I've done here. Then the next benefit of the Chicago plan is complete elimination of bank runs. That's pretty obvious, right? If you know that your money is there in the vault, either physically or electronically, because it's government is your money, you don't need to run on that bank. In fact, you'd be an idiot to run on the bank, right? What you have to ensure, though, is that it can be no bank run on the credit part of the banking business. And for that, you need to ensure that the liabilities of that part of the banking business cannot become quasi-money, which is something that exercised Henry Simons a lot, who was one of the original creators of the Chicago plan, but I don't have time to go into it. I have about 5 or 6 different ways in which you can ensure that these things do not become quasi-money. The most important one is the government never accepts that type of liability in tax payments. Never. And it also doesn't provide any FDIC coverage for it. So what this has to be, at the end of the day, is a risky investment. It's not an equity investment, it's a debt investment, but it's risky debt. Whereas when you put your money in the bank, the whole point of that is that it should not be risky, because money is essential for the payment system. And therefore it needs to, that's why there is FDIC, so that when you put your money in the bank, you look at that as a very safe payments medium. Okay, large output gains approaching 10%. There are 3 reasons for that. Lower interest rates, because you do a huge debt equity swap here, and what that implies is that in any good economic model, that would imply that risk spreads are lower, and that's also what we have. And that leads to higher investment and more capital stock and more output. Lower tax rates, the government takes in seniorage revenue here. Apart from that one-off huge seniorage revenue of 184% of GDP in this particular case, it also takes in about 3.5% of GDP every year, which is from just growing the existing money stock at the real rate of economic growth, which I assume was 2% here. Okay? If you grow a money stock of 180% of GDP at a rate of 2% per annum, you get no inflation and you get 3.5% revenue. And I'm assuming that that 3.5% revenue is used to lower distortionary tax rates that would then expand output as well. And finally, lower monitoring costs. In our present monetary system, a lot of really intelligent people are sitting out there monitoring credit risks, and essentially they're monitoring credit risks so that we can all have a money supply. It's a little exaggerated, because that's not the only reason. I mean, even if we do the Chicago plan, we still need lending, and we still need people who monitor credit risk, but not nearly as many. Because part of the reason why we need to have so much credit in this economy is because we need an adequate money supply. And if we can provide the money supply in a debt-free fashion that doesn't depend on debt being on the other side of the balance sheet, then that portion of the debt can go away. We no longer, for example, need to mortgage all the houses around so that we can have a safe backing for our money supply. It's not necessary, okay? And so that's also a resource saving that increases output. So here's a simulation of the Chicago plan. You go here about 60 quarters, 15 years. This line, the red one in each case, says where we will go. We will go in the very, very long run. The blue, black one, it tells you what the actual transition is. The most important thing is here, the big reduction in real interest rates, the big reduction in labor tax rates, also capital tax rate. That's what gives a big stimulus to investment. That's what gives a big stimulus to GDP. And along with all that, you also get a reduction in the steady state rate of inflation, which right now has to be positive because of the zero lower bound. In this world, it doesn't have to be positive. If I get to it, I'll talk about it. Stephen, how much time do I have?
None. How much do you need?
10 minutes. Is that tough? But I can squeeze it. I can
squeeze it, please.
Yeah.
This is just great, though, so I hate to say it's squeaky.
Yeah. You can control business cycles a lot better under the Chicago plan, because now a bank in this model, the bank is actually just like it's described in our textbook. It literally has to wait for somebody to bring in money through the door so that the bank can then take that money and lend it to somebody else. This is not true today, but it would be true here. And if I know that this is how the system works, if I have to go into that bank, I want to know that that bank is not investing in Spanish real estate and stuff like that. I'm going to be very careful about that. So the bank is going to be disciplined by the market much more than it is today, because there is actually no discipline in a new loan right now, because all the bank needs to do is to make new money available to this guy who wants to borrow. That's it. Okay, and so here's a little simulation. The black line is a credit cycle under the current monetary system, and the blue line is a credit cycle under the Chicago plan, when it's augmented also with window guidance or quantitative lending guidance, meaning the regulator insists on the banks putting adequate capital aside when they decide to lend a lot more than the trend. And so basically, all I want to highlight here is, under the current system, when the banks engage in a credit boom bust cycle, they can increase their bank lending by 50% of GDP over 3 years, and they create their own funding in the act of lending right here. And when they decide, suddenly they turn on a dime and say, now we're nervous, they can destroy a lot of this bank loans, and they just don't renew them, and they destroy the money supply along with it right there, with no chance of the policymaker, almost no chance, to do anything about it. And that, of course, gives rise to a very deep recession. When you have the Chicago plan, you can show in this simulation that there would still be credit cycles if banks have wrong expectations about the future, but they would be very much reduced. I don't have time to talk about the liquidity traps, and it requires at least 5 minutes of explanation, but under this model, there would be no liquidity trap, meaning the central bank would always retain the power to stimulate the economy, either through an increase in the broad money supply or through a reduction in the interest rate. There is no zero lower bound, and there is obviously no pushing on a string problem when you in the current system, you need to expand the monetary base and hope that the banks are then going to expand the broad monetary money supply. Here, you would directly expand the broad money supply, so no problem. Okay. Then there are some common questions, and I only want to answer two. People always say, oh, maturity transformation, well, especially the academics. They have written all these sophisticated papers about, oh, there's maturity transformation, and banks are good at this. Maturity transformation is not an end in itself. Maturity transformation just says, oh, you want people who can get access to short-term instruments for liquidity purposes, and you want borrowers to get access to long-term liabilities because they want to finance long-term projects. Okay, and then there's also a funding cost advantage here because you are able to get those short-term funding, cheaply because has a monetary function. Right? Now, under the Chicago plan, all those advantages of maturity transformation are present as well. In fact, they're stronger, but they don't require maturity transformation. All right. So in terms of meeting the objectives, we're actually doing better. You just don't require maturity transformation. Will government control over money cause inflation? This is, of course, the big boo-boo-boo, right? Ooh, government can only be inflationary. Right? Now, no, for 3 reasons based on monetary theory, monetary history, and the institutional arrangements that we propose. Theory is just basically in these balance sheets. The Chicago plan in the transition never changes the quantity of money in private hands. The quantity of money in private hands are the bank deposits here, right? They don't change. And inflation is determined by the relative supply of money and goods. And that does not change. What changes is what that money represents. In the original economy, that money represents private debts on the other side of the balance sheet. In the new economy, the money represents reserves of public money. Somebody at the ECB, when I presented this paper, said, well, you're basically switching from destructible to indestructible money. That's what changes. There is no increase in the money supply, no inflation. Then, of course, there's the whole history aspect. If you read this, you will know that governments have actually been better at managing financial systems than private institutions, although in some cases you have to go hundreds of years back to see the last episode where that was the case, for example, in the UK. The institutional arrangement, and then I'm ready to conclude, the institutional arrangement that we propose is that money issuance should be turned over to a fourth power of government that is independent, in a similar way to a Supreme Court judge. These guys would be like Supreme Court judges in their constitutional independence. They would decide by how much does the money supply need to grow every year to be consistent with macroeconomic stability. And the government can then just take that overall envelope, as I said earlier, that's about 3.5% of GDP, and it can then either spend it into circulation or lend it into circulation. It cannot get more because the government, the lawmakers cannot decide, oh, we want to print more money in. So this is an extra safety precaution. So, summary, whether this plan is desirable comes down to a cost-benefit analysis. And I've just run through these benefits for you. They are very, very substantial. The costs are, the transition of course could be difficult, and you know, there's lots of I's dotted and T's crossed to make the transition work. Substitute monies could become a problem if you don't do it right. All other arguments, and I've received many, many emails since August 2012, all other arguments can be debunked, right? As in bunk, they can be debunked, right? Given the large benefits, and this is all we're saying with this paper, of course this is a dramatic monetary reform, right? And you cannot just do something like that willy-nilly. But all we're saying is, given these large benefits, the difficulties of the transition, which is really the main counter-argument, would have to be absolutely enormous to justify us not even looking at it. Right? That's it. That's all. And then this is the very last slide. I use this normally to refer to some of the other work that we're doing. I'm very, very concerned about where the real economy is going. This is only my personal concern, but we have some IMF working papers on that, especially on fossil fuels, etc. And I think that over the next 10 to 20 years, we will need all our best brains in the real economy, solving engineering problems to make the real economy work better, because we're going, I think, personally, we're going to face, again, not official IMF, we're going to face headwinds. And we need all these good people there, right? But when we're always just thinking about having an exciting financial system, innovative financial system, then a lot of the best people go there, okay? What I argue here is what we really need is a really boring financial system, okay? Where there is a completely safe and crisis-proof payment system and lending banks that are textbook intermediaries. We're really just saying the banks should be like what our textbooks describe, and they're not. Okay, that's it. Thank you.
There could be immediate questions, but we have 2 more speakers and 25 minutes to do that. I want to encourage you, instead of doing questions right now, unless you really have an urgent question, then you will answer. I want you to read his paper called The Chicago Plan. It's about 70 pages. You can find it for free on our website, monetary.org. Just download it, print it out, mark it up, get in discussion, and any really urgent questions.
How does it relate to the first speaker, the war economy, the debt-based war economy?
I don't want to go there.
Okay. All right. Now we've got Jamie, who is going to talk about very quickly and give an abbreviated presentation of how HR 2990 goes through that final transition period from an accounting point of view. And Professor Kairi Yamaguchi is going to, again, he spoke yesterday with his presentation, but he has agreed to do another summary of it. And so, Jamie, you need, you got a statement?
Right, hi there. My name is Jamie Walton. I've been researching the monetary system for about 15 years or so. And for the last couple of years, I've been a researcher attached to the office of Congressman Dennis Kucinich last year and the year before that. And Congressman Kucinich introduced legislation actually at the end of the 111th Congress, and then again at sort of midway through the first session of the 112th Congress, called the National Emergency Employment Defence Act. And that's what I'm going to talk about. It's basically legislative, it's basically implementing the what Dr. Kumhof has been talking about in legislative form. And so there's three main aspects to it. The first is to incorporate the Federal Reserve banks as a bureau of the Treasury, like the US Mint and the Bureau of Engraving and Printing are already within the Treasury, so that all of the forms of money, coin, paper money and digital money, are all under one roof within Treasury, and to replace the Board of Governors of Federal Reserve System with a monetary authority, which is, as Dr. Kumhof said, it's important to be independent and autonomous from the government of the day. So it's like a fourth part of government, but because of the US Constitution is already in place, we can't alter the Constitution, or not easily, and it's not really necessary because the Board of Governors of the Federal Reserve System right now is basically an executive branch agency, and so this monetary authority would be an executive branch agency like that, but it would be authorised by Congress, and it would be accountable to Congress, and via Congress accountable to the American people. So,
Jamie, can you tell me which one?
okay. Let's see.
Michael.
It's probably at the end. Oh, yeah.
Okay, it'll come up. Just keep going, that's fine.
Yeah, okay. Now we've got it.
There you go.
Right.
Yeah.
Advance.
Yeah.
This one here.
You can make it larger, perhaps.
Sure. Yeah. To that.
Michael.
This is, yeah,
Michael.
Further down.
it's a little simple.
Do you have a microphone to Jamie with that microphone?
I got it.
Right. So I'll,
Still there.
okay. So these are sort of, three main points I want to sort of stress. We think that the whole ethos behind the bill is to be the minimal necessary to make the change, to implement the change, and to be as non-disruptive as possible. So it's not a big upheaval. It's a seamless transition from the present system to the new system. And so a lot of all this, what's in there, has actually been tried, is either already in place or has been tried before in the past. And there's historical examples of that going back through history. And also a lot of the procedures and technologies are already in place that's ready to go now. It's basically very, very minor changes, mainly to accounting, is all that's required. So yeah, there's the three main parts. I've started talking about the first one. The second one is to stop banks creating money supply. And the last one is to add money for the general welfare as the economy grows, grow the money supply in a similar manner so that you get a balance there. And the two main areas that we suggest for adding money supply for general welfare is, one of them is infrastructure, because the American infrastructure really needs upgrading, and another is education. So, people often say that education is one of the best investments you can make, and also infrastructure. So yeah.
Jamie.
All right. So. Okay. So as I said, the board of the Fed is already comes under the subject to the Treasury, the Secretary of the Treasury now under current law. So it's not, Congress often talk about the importance of an independent central bank, but it's really under current law. Not really. So there's what the Constitution says, and as Stephen said at the introduction to the session, the coin, the word coin there, it means to create or originate. So this is what the Treasury says. So the official government agencies already say that this is the power that already exists. And the accounting, as Dr. Kumhof said, the accounting is already set up to be able to create money with equity rather than debt. And so that's what US coins already are now. And there's the part of the handbook, and I've taken a verbatim quote there. So you see it increases the government's net position, so that means it hasn't increased the debt. So it's that. Okay, so this is some extracts from Dr. Kumhof's paper which explain this concept. And so it's see government equity rather than government debt, and the central liquid assets. So US money would be the settlement asset. At the moment, bank money is settled with central bank money. Central bank money is called the settlement asset. Under this system, the money is the money, and the money is the settlement asset. You don't need this two-step process. So when you boil down the flow of funds accounts, you get to this, and then again extracting from Dr. Kumhof's paper, if you set the growth rate of money to equal to the growth of real output, you really can't have any inflation overall. So for the first time, money is, in the bill, money is defined in law as a sovereign power, and it's an unconditional means of payment. That means that when you pay over the money, you don't have to do anything else at some future date. And so that is how we define what money is compared to other things like promises or IOUs. So the bill is broken up into 5 titles, and they each cover different aspects like what needs to be done. And so I'll just run through them very quickly, and we'll make this available on the website so that you can see them. As the governing principle of the monetary authority, it's got the Humphrey Hawkins provisions of the employment and price stability, and it's also the monetary authority has to make sure that the policy is to provide a sufficient supply of money that is not inflationary or deflationary, and is sufficient to allow goods and services to trade freely in a balanced manner, so that there's always a sufficiency of money, so that money should not be a constraint on the real economy. So again, this is the technical parts. Basically, the Treasury purchases the Federal Reserve shares from the member banks, and so they get paid in full. And Fed notes are replaced with US notes. And we'll have to go through this
We
some
can
other
read
stage.
it.
Okay. So this is how bank balance sheets under this Act, under this bill, would be rearranged. At the moment, you've got your deposits there and the liabilities part of the bank balance sheet. So we take them out, put them down there. They become custodial assets like a safety deposit box. And then to replace that, you have this IOU to the government, so that as previous loans, now this is all money here. It's not a promise to pay money, it's become money, it's become a settlement asset. So that as these loans mature, the principal is passed through to satisfy this IOU to the government, which is in consideration of taking that liability off the bank's balance sheets. It's replaced it with another liability. And the interest goes to the banks, so that's the bank's income, so that they don't lose any income out of this. And also they get to keep their own reserves, and they don't have any liquidity requirements on their own money, they can invest their own money, so they do well out of it. So there's already rules set up for safekeeping. The banks already know how to do that. So payments will be very simple, like just from two customers with the same bank would operate exactly the same as now, and two customers from two different banks would be direct transfer from one bank to another, from one safety deposit box to another safety deposit box electronically, and there's no need to settle reserves between the banks afterwards. And speaking with people who are like working the ICT for the banks, they say that basically the networks that they have now already do that, and they don't even know about the settlement of the reserves between the banks, people who work for the banks. So it's pretty much, that's the way the infrastructure of the payment system is already set up to do that. And so then you still have new loans and new savings and time deposits and that, but they won't be money. As Dr. Kumhof said, you've got to make sure that these don't become another quasi-money. So as Dr. Kumhof said, there's various ways of doing that, and one of the ways in the bill is described as just not being negotiable or not accepted and it's not accepted in payment of taxes or anything like that. So you'll have this true intermediation between borrowers and savers through the banks, which is, as Dr. Kumhof said, was how the present classical neoliberal paradigm thinks that the system works now, or neo-Keynesian or new Keynesian or whatever. So this basically, as Dr. Kumhof said, what is already the main economic theory will actually become a reality. So post-conversion, where will banks get money to lend to businesses? There'll be maturing from existing savings as they mature. Most people will want to reinvest that because people have put money in a savings account. Most people think that they're saving money and the bank is lending it to somebody else. So and the reason that they put it into a savings or time deposit is they don't need that money right now. So they will actually be able to save it and invest it with a bank or anyone else, a finance company or mutual fund, as they do now, and that money will now actually be available for lending by the bank. And because we pay off the debt as it comes due, and that the government won't be needing to issue debt, won't even need to roll over more government debt, that money can be reinvested in the private sector. And also the bank's own funds, as I say, they get to retain their reserves, and so they don't need to use these reserves for interbank payments or interbank lending. Well, they can use them for interbank lending, but they can also invest them, so there'll be money available for the banks to invest in businesses as well. And then the revolving fund, the money that is paid through the government goes into a revolving fund, which is administered like the Fed, sort of like the system open market account, but in reverse. So that the government lends money to the banks, and the banks provide the government with bonds or bills, bank bonds or bank bills, as IOUs to the government. So it's like the reverse of the way it happens now. And also, there can be additional temporary siege origination because the monetary authority, it's authorised by Congress, it's charged by Congress to make sure there's sufficient money supply. So that's something they will do because they have to by law. So again, you can have money being lent from the revolving fund through banks to borrowers, and as Dr. Kumhof mentioned in his paper, interest rate policy can become a much more effective tool of macroeconomic policy. And as he mentions in his paper, you could even have negative interest rates to stimulate the economy.
We've got to finish now because we've got to give Professor Cairo about 10 minutes, and that'll take us into the next period already.
Right. So that's what we want to avoid, is this continuous pattern, as Dr. Kumhof suggested.
And what I would suggest, we have a copy of this act here, the actual text of the act, enough for each one of you, and I'm happy to give you that. If you promise.